G'day expats and welcome to another episode of Expat Chat, episode 126 today. And today we're doing a deep dive back into our famous Facebook group, the Australian Expat Financial Forum. We're going to run through some Q&A. As always, joined by my mate and the guru from Australia, Mr. James Ridley. He's the Managing Director for the APAC region. G'day, James.
Good morning, Brett, and how are you? And for those that are joining us on YouTube, to my left, you can see Brett Evans, who is the Managing Director for the Europe, Middle East and Africa's region. And for those that are joining us on Spotify podcast, Brett is the silky smooth voice that you can hear dialing in right now. And today, Q&A session, Brett, there's plenty going on and there's some terrific questions in the Australian Expat Financial Forum, our Facebook group. If you haven't jumped in there, haven't added yourself, get in there. It's growing very quickly. I think the other day I saw that it's nearly past 3,500 members, which is terrific. All Australians living overseas doing great things, all with the same problems. So let's jump into it today. But before we jump into it, Brett, over to you for the disclaimer.
Talk about some very technical stuff today, so we are going to disclose that all the information we're going to share with you good folks today is for informational and educational purposes only. Please do not construe this as personal advice. If you need to get personal advice that relates to your situation, reach out to a specialist like Atlas.
Beautiful, mate. And let's jump into it. And first question, God, this is topical with the US election that we've just seen. A great question that Sheethan has put in. Does voting impact your non-resident status? Great question. I'm going to kick it over to you, Brett.
Mate, good question. And it's certainly going to affect a lot of folks with the upcoming federal election, which can be held between now and May next year, I think it is. So
Yep,
the long and the short of it is currently there's a lot of pieces of legislation, voting, Medicare, residency. When these laws were designed and built, there was no coagulation of these laws with each other. So if you look at who can vote legally, it says on the AEC website that you can vote up to 6 years or 5 years. I'll confirm that, after you've left the country. And after that, you then have to apply on a year-by-year basis to be added to the electoral roll. So if you look at the tax residency laws back in 1936, the voting laws that we currently work on weren't in existence. So there's no reference, there's no link as such. It's like Medicare. Medicare wasn't around when the residency laws were designed back in 1936. So there's nothing in there that says you can or can't use Medicare. But if you do a deep dive, and I'm talking 3 levels down on Medicare, you do need to be a resident to get it. And when you look at the AEC, it's a very similar scenario in terms of the entitlements. So yes, the AEC website says you can vote up to 5 years after leaving the country and then apply on a year-by-year basis to continue to vote from overseas. That is your, we'll say constitutional right. We don't have a constitution in Australia, but your legal right as an Australian citizen. But then we come back to that situation of the domicile and the resides test sort of scenario. And like you and I always say to clients, when you're moving overseas, do your actions map to that of a local resident? In my case, it's an Emirati. Would an Emirati vote at an Australian election? No. So that's it. That's I guess a very clean and succinct way to protect yourself. Yeah. I'm sure if you banged your fist on the table, would the ATO ping you for voting the election? No. But if you had other things going on, wife and kids are back in Australia, you're voting the election, you're using Medicare, which you're all legally allowed to do, then the weight of evidence is now going against you in terms of you claiming to be a non-resident and severing ties with Australia. So it is a slippery slope. There is no pure black and white answer. And the reason for that is purely based on the fact that these 1936 rules didn't take these into account. Under the new proposed residency rules, there is nothing in there about voting in the election. So under the new rules, it's very prescriptive, black and white, day counts, factor tests. There's nothing in there that says, did you vote the election? So under the new rules, yes, you could fill your boots and vote. But under the current rules, it's very, 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 very grey.
That's right. And it'll be, hopefully we hear more about those new proposed rules in the coming months. You just just don't know what the new government could do after May. So
Yeah.
we'll see what happens. But mate, let's jump into another question here. Sam KS, great question, Sam. I'm considering buying a house in Australia while I'm living abroad, but not move into it for at least 2 years. What are the financial implications of this? So good question. I'll jump into this one.
Please do.
So we'll make a few assumptions here. We'll assume Sam's a non-resident living overseas. We'll assume that based on what Sam has said here, he might rent it out or leave it vacant. We'll go both ways. When you're first buying a home or a house back in Australia, if you are going to leave it vacant, but you're not going to move into it for 2 years, as per the legislation, in order to establish it as your main residence, you actually need to move into it as soon as practical. Leaving it vacant for 2 years doesn't mean that first 2 years is going to be tax-free from a capital gains tax point of view. The ATO would treat this kind of property, even if it's left vacant, as an investment property first, even though you're not renting it out. And the reason for that is you haven't been able to move back into it and establish it as your main residence after purchasing it immediately. That's a really key one. Usually there's a bit of flex there, a bit of a grey area, I'd say up to 6 months, but 2 years too long. It's going to be treated as a normal investment property. Again, if you're renting out, it's going to be treated as an investment property. So you might choose to generate some sort of income from it first and then kick the tenants out and move in. It's up to you. If you don't want, maybe you don't want to have any wear and tear on it from tenants, so you're just going to leave it vacant and maybe populate it. Depending on what you're going to do also with coming back and forth to Australia, just got to be mindful of how that might look, having that asset vacant as well and not tenanted. If you're in, say, the Middle East, Brett, that's an easy example, Middle East, tax-free, if you're going to be coming back and forth between your home and back to Australia and maybe treating this a bit like an Airbnb in and out of it, I think that's something which the ATO would maybe consider, that you're trying to establish it as your new permanent place of abode, but you're trying to keep your non-residency intact, and it's a bit of a grey area. You know, there's enough room and wiggle room there for the ATO to put you under a bit of a magnifying glass and question your tax residency, which we definitely don't want if you're a non-resident working in the Middle East. So you need to just be mindful of that. But initially, if you're not going to be able to move into it and establish it as your main residence, it's going to be treated as an investment property for the first 2 years, which means later in life, when you eventually sell it, there will be a capital gain there, which will be taxable. So those are the main tax implications. If you're living overseas, there's not really an issue with you getting normally a mortgage, putting down a deposit. Just depends on your own personal serviceability, those sort of things.
I couldn't say it better myself.
Yeah, let's move into it then. Next one. Great question here from Shannon. We'll just see if we can address this one. It might be a bit more French related. Australian living in France and inheritance from an Australian relative and French law implications. Options to either safeguard entitlement or minimise amount payable. Ooh, not sure about that one. That might be a bit more.
I'm going to let the one go through the keeper. Yeah,
I think
we understand France
French
well.
Related.
Yeah, yep. We understand France well. We've got a lot of clients in France, but to me, there's a bit more to it. French have these old tax rules that date back to the 1800s. I would say, Shannon, love to help you out. Love to talk about the Australian side and those complication side, but the French side is the difficult one. Obviously, if on the Australian side, it depends on the assets. If it's a PPR from your parents, then obviously you can inherit their main residence exemption for a period up to 2 years. If you're inheriting shares, then that's where you've got to be worried about Category 3 event. So there can be an adverse taxing event if you're inheriting shares. If it's cash, it passes straight through to you from an Australian side. I'd love to talk about the French side, but I'm just not going to go there because that's a whole... Anyway, but sorry I couldn't answer everything in its entirety, Shannon. We are a compliant firm. We know where what we can and can't say when it comes to certain things. And but I'm sure there's actually a really good Facebook group dealing with trying to remember the name of it. I can't remember it, but I'll put it in the links show notes below. Deals with a lot of these sort of questions that expats in France ask.
That's right. And we'll move that into the next question, because we talked about it briefly from Craig, actually, about planning for a shared inheritance, real estate from family in Australia. pitfalls and how do I prepare here in the US and in Australia. So if you're a US tax resident, often anything, or to a degree, if you're inheriting things from from someone that isn't connected to the US, so they're not a US citizen or they're not a green card holder or anything like that, usually your inheritance or the assets you might receive might need to be put down on a information return in the US, but it's not a taxable thing. That's an important one. If they are, then there sometimes can be inheritance taxes in the US, but it depends if they're connected. If you're looking just purely from the Australian side, you've said planning for a shared inheritance because it's real estate. If it's the main residence, then you can benefit from that 2-year relief rule. After that, it's essentially taxable after that if you're going to sell it. And then if it's just purely investment properties, that's usually, and it's a post capital gains tax event, usually taking on the cost base of the person that has passed away. But because you're a non-resident, it means if you're going to continue holding that asset, you're not going to be able to access things like the CGT discount concession, those sort of things. So there's a bit of tax planning that needs to be done in the event you're going to sell it, trying to reduce your tax exposure. You've also got the US to put up with, and no one likes the IRS. We'll see if taxing Americans abroad gets through by the Trump administration. That was one of their proposals, not taxing Americans abroad. So all our listeners who are dual citizens that are working back in Australia, that's terrific news for you, but we'll see if it gets through. But that's a bit of a high-level summary on receiving an inheritance back in Australia on property. We'll kick it forward into the next one. Sean Brown. Hi team, I have 2 related questions. What are the pros and cons to having both a UK pension and Australian super if I plan to retire in Australia? That's part 1. Part 2, if considering leaving the UK, should I establish a SIP before I leave? Should I decide to move my UK pension back to Australia in the future? Oh, great question, Sean. Really good question. Now, I might get Brett to address the first part.
Yeah, look, I mean, having a pension in each country makes sense to me and for clients if they're going to travel between the two. So
100%.
what it does, it just smooths out the currency risk. You're able to domicile UK pension receiving pounds that accumulate while you're in Australia. So when you go back, it's there waiting for you. And the same thing for Australia as well too. If you're permanently moving to Australia, the conundrum you have is you've got exposure to a number of areas. Number 1, UK pensions are taxed in retirement. They're not taxed in accumulation. So the minute you retire, you'll start paying tax on any funds that you leave in the UK for that period of time. Number 2, currency risk. Who knows what the pound Australian dollar is going to do over the next 10, 20 years. You can reduce that risk of it being adverse or positive by combining it all into one, doing a RAPS transfer of your UK pension to an Australian super fund. We've covered off that in the show before, but that process, HMRC and all that jazz. So to me, what we've found and what I've found as well too is as clients get older, they become more risk adverse. So they want to start to really reduce things and make things simpler. So clients who sometimes leave their UK pension in the UK will eventually move it to Australia anyway because they become bit too convoluted in trying to manage it and those sort of things. So, and that sort of comes back to obviously the SIP. Should you move your UK pension to a SIP? The benefit of that is sometimes, depending on the size of your UK pension, you won't be able to move the whole thing in one go because you might breach the Australian contribution limits. A SIP allows you to do partial transfers, whereas some UK pensions, it's either all or nothing. So they either say, no, you can't take half of it now and then half in 4 years' time after you use the 3-year bring forward rule to increase your annual super contribution limits. So that's a bit of a deeper dive, but that I wanted to go in. But yeah, the answer is not yes and no. It just depends on your particular circumstances.
Yep. Great question there. And obviously a bit one in there. We'll get one more in quickly from Daniel. Are you aware that's of the rule coming into January by the ATO in regards to a clearance certificate when you sell a house being mandatory in order to work out your tax residents for capital gains. Currently 12.5%, going to 15% capital gains for expats, and no more threshold of 750,000. So to our listeners, Daniel is referring to the foreign resident capital gain withholding tax provision that exists. Current form, if you sell an asset and it's more than 750,000, there's meant to be a 12.5% withholding on that transaction. And the reason this was implemented was to prevent foreign residents buying property, selling it, and not paying any tax and forgetting to lodge their tax returns. So this is why Australian expats who are non-residents get captured in this, which is really, really annoying. They are updating the threshold now. They're removing the 750K threshold, so it'll capture every property transaction if you're a non-resident or a foreign resident, and they're increasing the percentage to 15%. In the event you actually haven't made a capital gain, you can have an accountant like our Director of Tax, Ben Turner, do a variation to reduce the withholding rate, but there needs to be calculations done prior to the property being settled. So that's a really important one. But yes, that is coming through. It is prepaying the tax, but then you get the tax back if you've overpaid tax when you lodge your tax return. That was a really good question, Daniel. I think I've answered that pretty succinctly.
Mate, couldn't have said it better myself. It's something that a lot of folks don't realise came in to force after they've left, the country. Whether you've been overseas for 5 or 10 years, this is only a relatively new thing in the last 5 or 6 years. So it is a thing. Don't be surprised. They're not holding everything back. So, it is something you need to factor into your equation. So, but mate, I think we've done a good service there. There's more questions which I think we'll come to at a later date. We could get going talking for a long time. Thank you very much for your stewardship and guidance on this, and we'll talk to everyone on the next episode.
Sounds good. Thanks for tuning in on next episode, guys. Speak soon. Thanks, Brett.
Thanks, mate.